All right, let's talk about a company that's basically a fortress in the Indian financial market, CDSL. For years, this thing has been the definition of stability, of dominance. But some cracks are starting to show. So we're going to dig in and figure out what's really going on here.
To really get a grip on CDSL, you've got to start with this one number, 76%. Yeah, that's the slice of India's retail investor demat accounts that CDSL has under its thumb. They are the gatekeeper for pretty much every regular person investing in one of the fastest-growing economies on the planet. I mean, you can't even call that market leadership. That's just straight-up dominance.
And that, right there, is the big mystery we're tackling today. If this company is so powerful, so dominant, why on earth are its profits suddenly taking a nosedive? Let's piece this puzzle together.
So, first things first, let's really understand what makes CDSL such a beast. We're not just talking about a big company. This is a foundational piece of India's entire market system.
The whole market is what you call a duopoly. The regulator, SEBI, has only given a license for this job to two companies. Just two, CDSL and NSDL. This creates this incredible protective barrier, a huge moat. You can't just wake up and decide to start a new depository. You need the government's okay, and that pretty much locks out any new competition.
Okay, so we've got a protected duopoly. Now let's see how that turns into what I'm calling a financial fortress. The numbers, well, they speak for themselves. They're pretty impressive.
Look at this chart. It just screams efficiency, right? CDSL's net profit margin is an absolutely staggering 48.6%. That's more than double its only rival. Think about that for a second. For every 100 rupees they make in revenue, almost 50 of it is pure profit. It's just an incredibly well-oiled machine.
And the company's health is just rock solid. They have zero debt, they deliver amazing returns to their shareholders, and they're consistently paying out dividends. These are all the green flags you look for in a fundamentally sound business. From this angle, that fortress looks like it can't be breached.
This strength didn't happen by accident. It's all about strategy. While NSDL went after the big fish, the institutional clients, CDSL made a bet on the little guy, the retail investor. And now they totally dominate this massive growing part of the market. It was a numbers game that just paid off beautifully.
But, and this is a big but, this is where our story takes a sharp turn. Just when we're sitting here admiring the sheer strength of this fortress, the latest numbers show some pretty worrying cracks starting to appear.
I mean, everything we've looked at so far points to just pure strength and dominance, right? But the company's newest quarterly report, it tells a totally different story. And frankly, it's a much more concerning one.
And here it is. This is the number that's got everyone worried. A 23.6% drop in net profit from the same time last year. After seeing all those incredible financials, a drop this steep, it's a huge red flag. So you have to ask, what happened?
The report lays it all out. First off, those amazing profit margins, they're getting squeezed. Revenue growth has practically hit a wall, slowing to almost nothing. And this isn't a one-off. It's the second quarter in a row that profits have dropped. All while their costs for tech and for people are climbing. It's like the walls are closing in from every direction.
So what we have is this dominant company with a fantastic history that's suddenly hitting a bit of a wall. But there's one more really important piece to this puzzle, the price. What is the market actually charging you to own a piece of this company?
And to understand the price, we got to talk about the PE ratio. Just think of it like a simple price tag for a stock. It tells you how many rupees you have to pay for every single rupee of profit the company actually makes. The higher that number, the more expensive the stock is. Simple as that.
And here's the kicker. The average company in this space has a PE of about 28. CDSL's is nearly 66. Whoa! The market is charging this massive premium for the stock. It's pricing it for perfect, non-stop growth, right at the exact moment that growth is starting to sputter. This quote from an investor forum just nails the dilemma perfectly. On one hand, people believe in the long-term story. They see it as this super safe stock you can buy and hold for your kids. But even the true believers are getting pretty nervous about paying such a steep price for it right now.
Okay, so let's pull all this together, the market dominance, the recent problems, and that sky-high price tag, and see what the final verdict from the analysis is.
And the final call is a hold. With the stock trading around 1,559 rupees, the analyst thinks its fair value is way lower, at 1,350. Now, this isn't a call to go out and sell it if you own it, but it's a pretty clear warning.
At this price, the risk might be bigger than the reward. It's just not a great time to be buying in. So for anyone thinking about jumping in, the report offers a clear game plan. Number 1, be patient. Wait for the price to come down to a more sensible level. 2, if you already own it, make sure it's not a huge part of your portfolio. Keep it small. And 3, you've got to watch those profit margins and growth numbers like a hawk every single quarter.
So that's where we land. You've got this incredible, dominant business, a true fortress. But it's a fortress that's showing some real wear and tear, and it's being sold at a price fit for a palace. So the big question, the one you have to ask yourself, is this: what's a fair price to pay for a fortress that has a few cracks in it?